Good morning, everybody. Welcome to the Flow Show. Can I just check you can hear me okay? Because Zoom decided to update everything overnight and I lost all my settings. So, Kate, you all right?
Yeah, hey, mate. Yeah, we hear you fine.
Good.
Loud and clear.
Always. Yeah, always love it when you switch on, open up Zoom and everything's gone.
Yeah,
all
then
the logins, all the save stuff and everything. If it ain't broke, don't fix it.
yeah,
Right.
it seems it's updating pretty regularly. I've got it regularly too.
Yeah, all good. Everything's working. That's the main thing. So let's get stuck into it. I hope you all had a good day yesterday. And let's go over some of the headlines and whatnot. Going to start with a bit of data out of Japan. Overnight, unemployment rate coming in a little better, 2.4%, though that jobs application ratio was a little bit lower in December. Industry Minister Saito said that the US decision to pause the expansion of American LNG exports is going to be an issue, and Japan will take necessary efforts to secure safety energy supply or safety of energy supplies. Not really a big headline in itself, but if Japan, which is heavily dependent on importing energy, oil, gas, and whatnot, if they're forced to shop elsewhere, that means likely they will be paying a higher price, and that will bring an inflationary impact. So just one of those things in the back of the mind to keep an eye on. There's been some grumblings from some of the politicians in Japan, and Shigeru Ishiba has said that the Bank of Japan must immediately end its negative interest rate policy, saying that that policy has hindered boosting productivity by keeping rates low. He says it's an extreme policy that shouldn't exist in the first place. He also said that the BOJ may face political pressure to keep funding rates low for any spending packages to come over the earthquake. Now, this guy is widely tipped as a big favourite to become PM to replace Kishida should that happen. So his words might be a bit of a harbinger of what might come if Kishida gets ousted or there's a change over there. But anyway, shows the difference of opinions amongst the ruling parties over there. Anything? The political stuff over there seems to be getting a bit more rockier at the moment, Kay.
Yeah, but we've got to know that Ishiba has always been against whatever that they decided. He was also running against Abe back in 2012. So it's not a surprise that he talks that way. He hasn't ever talked any other way. He was also straight away against Kuroda's forceful easing and driving rates negative. So there's not a surprise that this guy is talking that way. Regarding the LNG things, Europe also already reacted to it. It looks like short term, there shouldn't be too much of a problem, but it's more like the longer medium term and the longer term that could create problems if Biden goes through with this plan, to shut those LNG projects.
Yeah, so, and this is all part of the green stuff that they've got going on there. Yeah. So nothing to do, it's nothing political in terms of geopolitical, but it's all climate stuff that they're doing over there. But anyway, on top of all the differences in being able to transverse the Red Sea at the moment, it's just making all things a little bit more riskier for gas, and likely to continue to see maybe an upside in prices on that as well. Right, moving on anyway for some other data. Aussie retail sales looking a bit soggy, coming in at minus 2.7%. We're expected to only fall 1% for December. So that positivity in November 1.6, which was revised down, falling out of bed in December. So not good numbers there. We've got the RBA coming up next week. Over to the RBNZ, and RBN's says Conway says non-tradable inflation is a long way from 2%. That was a number that came out last week that saw the Kiwi rallying even while the other CPI numbers came down a bit. So he's saying that's stickier. That's also prompted the Finance Minister, Willis, to come out to say inflation is still too high. The next RBNZ meeting is 28th of February, so quite a while away, about a month away from that one. But perhaps, Kay, we might be getting a bit more of a hawkish tilt to things.
Yeah, I mean that's leaves a month to buy kiwi, but yeah, I think it's we were wondering about that after the weekend, and then the kiwi yesterday when the dollar printed roughly around its highs was testing that 60.90 again, and it's always been a bit of a zone. Yeah, and, we have traded below, but yesterday again it held that level. So it's really on a close daily closes. That level is going to be an important one to reckon with. And now we are bouncing back into where we saw those little spikes before. Also. A week and a half or so ago, we stopped right there in that 61.40-60 zone, and now we're looking at that side. So we've got a pretty well defined play area in that kiwi. But if the dollar shows any signs of weakness, I've got the impression that there's a fair chance we may go in for a bit of a more thorough test of that resistance zone there. Kiwi is one of those currencies where nobody pays attention to until one does, and seeing that it's not a very huge market, when it starts to move, it can move quite a bit, you know. So we have to pay attention to that resistance zone, in my opinion. It could come under pressure.
Yeah, thanks, mate. Over to his nibs at the SMB, Jordan, talking about inflation, says the situation has improved and it looks relatively good, and that inflation should be below 2% in 2024. Back to the data front, we had data out of everywhere in Europe this morning. Start off with Europe, France consumer spending coming in okay, but GDP coming in flat on the quarter, 0.0%, still flat reading from the prior quarter. These are all the Q4 preliminaries. Year-on-year GDP up a pip to 0.7 from the prior 0.6. CPI dropping down as well. Spain kicking things off with a jump in CPI. Their main CPI measure up to 3.4% from 3.1%. The HICP number also coming in hotter than expected, was expected to drop 2 pips. So it went up 2 pips instead, 3.5% there. Their core number staying sticky. Spain's core number, which if I recall correctly, is 3.6%. I'm just having another little check on the numbers. Give me 1 second. If I can find them. Where are they? There we go. So their core number came in at 3.6%, was expected to drop to 3.3% from 3.8%. So sticky inflation in Spain. GDP, though, looking fairly good, coming in better at 0.6% on the quarter versus 0.2 expected. 2% year on year, also better than expected. Italy as well, slightly better than expected, 0.2%. On the quarter was expected flat. That's Germany as well, coming in minus 0.3%. No surprises there, coming in as expected and showing a negative there. All those numbers kept the pan-Eurozone number from dipping into a technical recession. We had 0.1% last quarter, came in flat this quarter. Not exactly time to light the fireworks and get the Julian ice cream out. All 0.0, 0.1s, point this, point that. So very stagnant growth still in the Eurozone, but technically avoiding a recession, or avoiding a technical recession, I should say. BOE had some numbers out as well. Consumer credit, as you can see there, coming in at just under 1.2 billion, lower than expected, lower than the 2.06 billion previously. As always, I look at the credit card numbers. They did jump up from 500 million to a billion in November. They've dropped back down to 300 million. So that November retail splurge that we saw all going on the plastic has dissipated in December, which perhaps doesn't bode well for New Year numbers if the belts are being tightened. So some potential forewarner for the next couple of retail sales numbers, perhaps, that we'll see activity pulling back in those. Mortgage approvals, slight miss on expectations by just under 2K, but still a positive number up on last month. Again, end of year stuff, so not many people move house at the end of the year, so we need to see the early January numbers to get a proper idea on that, whether there's a pickup from that. The ECB's bookend, De Guindos, who stands at these ECB meetings alongside the guard and usually doesn't say anything. He was out with a speech saying that inflation risks are to the downside, and he thinks that the disinflation process can continue. We're playing the expectation game still for the first ECB rate cuts. March pretty much out the window after last week's ECB meeting, and April is fully in the crosshairs. Now, after the ECB, we jumped from a 60% chance of an April cut to an 80% chance. Now, yesterday morning, it's fully priced for a 25 pip cut in April. So we're playing the expectations game again. We still know that most of the ECB are looking at around middle of the year, so June, maybe July, that sort of period for the first rate cut. And the market's still pushing for earlier. Olli Rehn, he's finished playing politics. He was trying to become president of Finland. That didn't go so well. So tomorrow he's returning as an ECB Governing Council member. So we're going to get his views, chapter and verse, on monetary policy. Further data from yesterday, just a small one in the manufacturing sector. Dallas Fed Manufacturing Business Index down 27.4 from a prior minus 10.4. So looking a bit soggy like we saw in the Empire numbers. Some of the other regionals have been soft, but not as bad. But it doesn't look like we're getting decent numbers coming through, even though we saw a pickup in the PMI last week. So a bit of disparity between different regions. ISM, I think this week, Kay, is it? We get, I haven't checked it. Both of them we get this week.
Isn't it next week?
Is it next week? Is it?
There's so much stuff in there, but let me double check while you're talking.
Yeah. Okay. I'll have a quick look myself.
I'm going to check, but I
yes, Thursday. Thursday is the ISM manufacturing. Yeah. And the week after is probably services.
Yeah. Okay, that's
yeah, because it's not Friday.
Yeah, manufacturing is Thursday. When I look at the calendar, it's like endless this week.
Yeah, bit of a big one. So that'll be something to keep an eye on. We'll finally get what the big numbers are. Right, we've had all this palaver over the Treasury's Q1 borrowing estimates. They've been carved down by around 50.6 billion, or 56 billion, I should say, to 760 billion. Kay, any moves on those numbers? Bit of relief in the market? Or?
So the market took it as positive, sent the S&P through that 1618. Yields came off a little bit, but okay, the move was, I wouldn't say short-lived, because the dollar is still weaker than where it was prior to the announcement. So it's a positive. It's weighing a bit on yields, but we still have to look at the repetition tomorrow. That's going to be for tomorrow, whether they still would do more bills than bonds as they did in November, which really moved the needle quite a bit. But also the next quarter expectations was extremely low, and that I think had perhaps a bigger impact than the immediate quarter, because those expectations are really very low. But they're expecting more income, more fiscal income, and um, hoping that they won't need to borrow as much. So, yeah, it was weighing on the dollar, was weighing on the yields, and underpinned the equity markets. Um, that's about what we can say about it right now. I think the market is waiting for the FOMC tomorrow as well to really take
Yeah.
take a clear direction. And we have a lot of data out this week, and we have also big earnings out this week. So I guess the market is what I sometimes say is waiting for the whole package to come through, and then pick a real direction, right? So that's what I'm thinking about it. But the initial reaction, yeah, was to send the dollar a bit lower and risk a bit higher. And but it's been, how should I say, it's a bit uneven right now. But yeah, I think the market is really waiting for the whole package now to pick a direction.
Yeah, no, I agree with that. Big old week we've got this week. So yeah, the market probably not willing to go out on too much of a limb either way. In oil news, Saudi Arabia has told Aramco to lower its maximum capacity target down 1 million barrels per day to 12 million, which lots of speculation going on why they've done that. Some are saying it's the demand situation. There's just not the demand, so why produce as much? Others are saying that it's another attempt to keep prices afloat, but whatever that has happened, not too much of a spillover in oil prices, but it does highlight that take the geopolitical risk out of things, and you've got to ask whether oil would remain supported in that scenario. But we can look at that prices in a moment. That's what I've got from the headlines. I was off this yesterday. So, Kay, anything else you need to bring to our attention?
Well, I read this article in the FT this morning, and apparently tomorrow, 31st is tomorrow, yeah. There are new Brexit border rules coming into force, and new checks between the EU and the UK, and I'm not sure whether that is what is keeping the pound a bit under the cushion. And then we had that consumer inflation coming down, but as I was saying in the room, ahead of the BOE, those are perhaps things that the market is going to take as a bit more defensive for the sterling. So this is perhaps what is weighing a little bit on sterling this morning. And as we've been saying so many times, the market is getting sometimes a bit emotional about sterling. So if this would see a bit further comments, and if by any chance the BOE would be a little less hawkish than the market may expect after the latest data, it could weigh a bit on the sterling, those kind of things, because it's always good and well until something like this is starting to weigh on a currency, especially the sterling, and then all of a sudden we go the other way around. Yeah. Um,
Yeah.
Apart from that, I don't think that there is a lot really to talk about. I haven't seen really too much really world-shocking headlines out, apart from the geopolitical stuff and that and all of that. In regards to what you said about the windows, it seems that the doves came out of hibernation over the weekend and yesterday, and they finally have the right to speak again. And that sent the euro crosses a bit lower yesterday, but they are on the recovery path as we speak.
Yeah, yeah. Well, those inflation numbers, which are to be expected, because the Guard and Co have told us that they expect inflation to be picking up over the next couple of months, and we're seeing just that, particularly from Spain. I think if the others follow suit as well. We've obviously got the pound eurozone number on Thursday. So if when we get all the West Germany regionals are out this week, and the main German number, so if they're all pushing higher, then it's gonna push the doves further into the shadows. I think for that one, at least keep the rhetoric going for middle of the year rate cuts, which will then see an unwind of those April pricing. So we're doing all the pricing game yet again, but. Yeah, it certainly seems to have put that, and the GDP number certainly seems to have put a bit of a tailwind into euro pairs at the moment. Euro sterling in particular.
And you know, Ryan, Lagarde also said something about those that she saw some improvement, some green shoots, or so we can call it somewhere. And I'm not saying that she knew the numbers already, but when if Eurozone manages to escape from that recession feeling, the market has been trading the euro quite negatively over the last even months, because even when the dollar was under the cush, euro crosses tended to come off perhaps a little bit at some point, but. If the market needs to price out recession in EU, or just things are not as bad as we may have expected, or we may have seen the bottom, there is perhaps a case for the euro to rebound a little bit.
Yeah, and we were saying it all last year. Don't expect growth to collapse, but not expecting it to jump higher. Flatlining around that 0% mark. Maybe plus minus 0.5% here and there, and we're seeing exactly that now. And I don't see any reason for that to change. So as long as it's not collapsing, that doesn't force the central banks to need to cut as hard and fast as they might do. It just becomes a bit of a smoothing process, just to ease conditions slightly, just to stop things from falling off a cliff. I think that's going to be the best result they can get out of all this. But I'm actually still backing the central banks at the moment, in that the market is still way too early with expectations for rate cuts. And the data we're seeing says just that. Not great, but not disastrous either. Germany perhaps being the exception at the moment. But anyway, as I said, looking at euro sterling, and this goes a bit into your question, Ali, about how to decide how much risk you should place on a trade. How can you predict whether a trade you can go with a bigger size, or you've got more conviction in one trade or another. It all depends on the trade. If you're trading intraday these levels here, for say in euro sterling, let's use that as an example. If you're scalping between the levels, you're not going to be going big size. You're not going to use big risk. But when you start hitting the big levels, and you've been following the show long enough to know how long we've been banging on about this 85, 87 range, and particularly me, how big this 85 level is. When you hit these big technical levels like this, that's when you can perhaps look to take a bit more risk, because these levels don't come around that often. And if they hold, they can give you big rewards. So it's worth taking a bit more risk perhaps on these sort of big levels. You don't do it pissing around in the middle here, trading between 86 and 86.20. But when you have the big levels, like if you've got the big levels up here, up into the, well, I'll go even further, up into the 90s, when you've got big, massive tops coming in, you can have a bit more on the table, because you're not going to be trading these every day. You can be trading these, once a year, twice a year. And so it's worth risking a bit more to try and catch the bigger moves you may get out of those. Now, if you want to scalp it for 20 pips and that's your strategy, then you don't want to be risking more. But if you want to get in a trade down here at 85s and want to run it up to 90s, well, then you've got to manage it a different way. And you can, as I say, you can look to go a bit larger risk on it. So that's how you decide how much risk to put into a trade. If you've got a day-to-day strategy, you risk 20 to make 20, that sort of thing, then you should be trading a standard size. You shouldn't be increasing that risk on those trades just to capture more. Scale up your trading as your profits scale up. Nothing wrong with that. But if you risk 500 quid on a trade, and the next day you decide you're going to do exactly the same trade and risk 1,000, well, you've got to justify that that increase, unless your account has grown sufficiently to that trading 1,000 on that trade was the same as trading 500 6 months ago, or whatever. So it all boils down to the trade you're looking at. But anyway, back to euro sterling, and I said, seeing a bit of a bounce. I was bid down here into 85.05. We never got that far. We've carved up through this minor level here. We've now tapped into this more significant former support point, 85.50. So this will be a good measure for this bounce. If we get above there, then we're going to be perhaps chewing up maybe as high as the 86s. But if we can't get above this 85.50, I don't really see anything that should send us that much higher. It'll be interesting to see whether we then start creeping back down towards those lows. If we come back quickly to these lows, then that's going to spell trouble. We can't get and hold below this 85.20 area. So that's proving the sticky area at the moment. If we do, then we're going to be testing that 8,500, and then we'll see what happens. We've also got the BOE risk. So as I mentioned in our chat room today, anything you're trading on the quid, you want to be looking at it on a closing basis for this week, because you can get a lot of noise. We could be up and down over this 85 level. It could get busted. Anything could happen. Where we close the week will be important. If we close above it, it will likely firm up as support again, even if we've had a break under. If we bust under it and we're holding under it at the end of the week, then that would suggest we're going to see some further downside and the level is broken. So it's always difficult. I'm interested in trading this. I doubt I'm going to have any bids in over the Bank of England, though, if we're just 20 pips off the level. I'll see what happens after the BOE and after we finish the week. But for now, this area is holding as support down here. Kay mentioned the Kiwi. I'm having a look at Aussie dollar. Still looks glued to this bloody 66 zone, not getting a real break out. Can't get above this 66.20 area and hold a move above that. We've had another high, so it is cracking the egg a bit, but still in this very tight range at the moment. So something's got to happen there one way or another. Talking my book, I hope it's up. If we do get above there, then we face the 66.40 area, just 20 pips above this 20 area, which was all that support previously when we were breaking down. So that's the next big level for me up there. And then we get into another traffic zone as we get into the higher 66s. One more I want to have a quick look at just as an update, and I shall hand it over to the K-Man. S&P, that's continuing nicely. I've been trying to, how should I commentate on this one daily, just to see how things develop, just to show how I deal with price action, watching the price action. So I've had a little bit of a redraw. You know, all these levels here. I had my fib at that point. Now that's gone up to this point, this high. We've got a new potential zone of support forming. That was a resistance zone. Now it could be a support zone. We haven't had a retest yet. So I'm looking for similar price action that we saw around here, maybe happening here. So we had indecision. We had the break. We had the retest, confirmed it, the break of support. We haven't had a confirmation yet that this area is support. I suspect it will do, depending on what move drives it down there. So that will, while that happens up here, this means that all this support down here is now firming up. So this becomes stronger and stronger. Got a little intermediate number there around 48, 80, 90, just where we had this little support area here. So that could, again, firm up. And now we've got a bit of a intraday range, 33s the highs and 20, was it 21s, 20s. So again, similar situation to down here. What's it going to do? Ping around, maybe break up, maybe move down. All about watching. But for now, I'm still long and happily to stay long in this one. The price is doing exactly what I'd like it to do. Kay, you still holding in this one?
I went out, but then in the meantime, I've just bit of scalping, bit of jobbing. It does look like we are going to push through. And as I was saying yesterday in the chat room, I suppose the 5K caps are getting prepared and printed right now. You know, make the S&P great again. And yeah, it's depending on what the FOMC will say and the perhaps the jobs report as well. If there's no big disasters, this thing looks set to go and print the very big figure soon, right? Unless we start to get back below, yeah, that 48 and a half probably. That's probably going to tell us enough to say like, oh, right, we've tried. We are turning about the around that extension level right now, and if that starts to build a base, then probably 5K is just around the corner, I would say. But we still have like a big earnings week as well going on.
Yeah,
That will have an impact as well. So there's a lot of stuff
Fed.
that can impact.
Yeah, the Fed as well.
Yeah,
Yeah, if there's a bit of a hawkish pushback, that's likely to hit stock, so it could be a bit choppy. But again,
Yeah.
Ali, to go back to your example there, you know, this was a trade I was happy to go bigger risk on because it's a big, strong area, and what usually happens if these sort of levels break, you get a decent bit of follow through. You know, and it's up. You know, this is 4,800 we're talking around here, and we're up 130 pips from that. So, you know, that's, again, it's an experience thing. I was happy to go a bit bigger risk in this, you know, and days before, probably 2 weeks before, I was thinking this is going to blow. It's a bit of a gut feeling. I'm happy to put a bit more money behind a trade because I can still keep the risk fairly manageable, fairly low. But I know from experience when you hit big levels and when big levels break, you tend to get a big follow through. And that's where you try to maximize that with your trade size. But yeah, for the short term, it's going the way it wants. But when a trade goes the way it wants, I'm not interested in whether it goes further. I'm interested in when it goes wrong, because that's when I need to protect the rest of my profits. So that's why I've been doing all this intraday drawing on my charts to find out where can the trade possibly start to go wrong. You know, and the levels that it needs to break to show that it's going wrong, because I want to protect what I've made and I want to protect what I've got left. If it keeps on going up, fine, that's a bonus. But that's not where my mind's at. I'm always looking at what can go wrong with my trade. Cover that, everything else takes care of itself. Right, Kay, do you want to take it over?
Yeah, just a couple of things to show perhaps today. And one that we've been talking about, and I've been talking about as well, is this dollar cat, right? And we are there. It's like when you're in a park walking around and you need directions, and the only thing you see on the map is a big arrow with saying that you are here. And well, we are here. Look at this level. This one here. Here we went quickly below and then rejected and started to move higher. This one is a bit perhaps less. This one fell a little bit short of it, 133.90, but you see the importance of this 134 in dollar cat. And we are there. So this is one to keep an eye on for the rest of the day. Perhaps not the ideal day to go for breaks or so, or to go for sustainable breaks of anything, because we don't have like big data also to show us the way. But you can always look at what oil is doing. If we find support here in this those 76s on oil, and we start to go back up, this thing has a fair chance to perhaps give it a go and have a look at what's happening around mid 133s. You see, that's going to be the next level, mid 133s. If the break is strong enough, if FOMC, for instance, tomorrow comes out a little bit dovish, then I reckon there's a fair chance we are going to look for 132s. But a break isn't the break until it breaks. Okay, we are right on it. And as I was saying in the room as well, looking at the Euro Canada, looking very fragile. This is looking very fragile, but things always look the most offered at the bottom and the most bid at the top, as we have seen here. Two very good examples. So for the time being, watch this. I'd say watch for a confirmation of 145 if this goes lower, but it does look fragile in my opinion. Despite we're seeing a little bit of a rally right now in all the euro crosses. I think that's thanks to two factors. So the first is obviously those data that Ryan already showed a bit earlier, showing us that Europe, the Eurozone, may avoid a recession where the market has been trading the euro on the soft side because of recession risks, because of the data underwhelming versus other countries and or continents even. And but today is a bit of a day where the market seems to say like, well, hang on just a little bit, and we still have the FOMC and everything. Just hang on, and the euro crosses have seen a little bit of a revival. Yesterday I was showing this 107. It's just in those low 90s, bottom end of that little channel as well. We tested it and then bounced. We did the lows around fixing time. You know, I was telling you about the value date, US corporates. We've been talking about that very often already. We did see a bit of that dollar demand into the London fixing yesterday, and then it was sort of over, and we moved back higher. You see this here. This is the hour into the fixing. That's the fixing printing around the lows, and then we bounced a little bit. And this move then was helped by the what the Treasury announced, and then we had a little bit of a move higher. We are in some intermediate but very intraday zone here on the euro dollar. It's looking a little bit better, I must admit. Me being a usually a euro sort of bear. I'm not a perma bear, but I'm a euro bear mostly. It does look more constructive, and as I'm saying, this is we find it back on the euro sterling as well. Well, you know, I've been in this position for a long time, and I cleaned it up this morning. There was these several factors. This consumer inflation starting to go down. This what I was telling about tomorrow. Those new checks, EU. Sterling looked a little bit pushy yesterday, even after the US Treasury announcement. Yes, cable bounced. Usually when the dollar goes down, sterling goes a little bit faster than the euro, but the euro went actually a bit faster than the sterling. So this morning we had a retest here. You know, this 85.20 has always been that little bit of that level before the 85, the big figure. Tested it below again and couldn't hold. So this morning I just let all my sterling go. I let the rest of the cable go, and I finally bought my euro sterling back because I don't want to end up with the BOE and all of a sudden Bailey going back to his own dovish self, catastrophic self, and then the market all of a sudden turning around on sterling and finding myself somewhere around 85.75 and needing to buy back a lot higher than what I was expecting to. So I'm flat sterling. Looking at this 85.5. The thing is though, as I was already telling a few times, these offers here, 86.20, they came down to 85.90s, then they came down to 85.60s, and I said like, well, this is, I'm a bit curious to see if they would come down to those 85.40s, which was kind of happening last time. We're back at this level, so I'd say be a bit careful if this thing breaks 50, 55, 60 on euro sterling. I think some may need to run for the exit just ahead of the BOE, just not wanting to keep too many positions on the books before the BOE. So that is now a little bit my risk that that I was looking at. There's a bit of a risk that the market forces some people to get out of euro sterling shorts ahead of the Bank of England. Not saying the whole picture is changing, because as James in our room rightfully said, if they just steer the course and not start to change much to their wording, sterling is probably going to see an extra leg higher, and then we probably will put pressure on this 84.90, 85 the figure. But for the time being, I prefer to err on the safe side of things. And there's really, there are a few things perhaps that I want to show. Dollar yen, not so much, although it does feel like the yen is doing a bit better. And I wouldn't think it's on those Ishiba comments, but yesterday already, when the dollar came off, dollar yen was quite easy to come off, and we are starting to print a bit lower highs here. Okay, so need to be paying a bit of attention to it. Of course, this is going to be very much influenced by what the FOMC will decide and where they are putting, especially the tens, right? But for the time being, it's looking a little bit on the defensive. And I was also looking at this euro yen. And perhaps euro yen can put in that little bit of a revival. Now the market is trying to buy back some euro crosses, but this is looking for the medium term. Okay, looking as this 161, 162 has really been very, very difficult to break back to the top side. And this is if we would get an area back up into this area, I'm going to really think about perhaps entering some stuff. And if we look at the downside, this area here around 158.75 down to 158.5 is going to be pretty important. Yeah, we can stretch it down to even 157.5, but if it really breaks 157.5, then it's lights out, I think. But already here, if ever we would come and test this 158.75, pay close attention to the euro yen, I would say. For the rest of the day, I'm not really. Oh yeah, I was talking about the Kiwi. So look at the Kiwi. I was saying like that 60.90 zone. Yeah, we had one move below, one close below, when the dollar was doing all right, and then started to move up again. 200-day moving average here as well. 60.90, 60.90, 60.85.90, 60.85.90 here. It's really important. And I was also saying, keep an eye on what's happening now in the 61.40 to 40.55, and then you add the cloud around 61.65. This is going to move up, so it's perhaps a little bit more difficult to trade on the back of the cloud. But if you start to break above 61.50, 61.55, 60, let's put it there, I would say this could start to push through, but it's probably going to need some help from by Mr. J. Powell. Okay, Derigi, sterling yen, where is it? Yeah, I was looking at it also. Looks to find this around the top, right? 186.5, 186.5. If that starts to go and we are not that far away, and caps on a close, this could perhaps go a bit lower. The cloud is too far away. But I was also looking at that, and this is going to be one where the Bank of England has a say, right? On Thursday especially. But yeah, 186, around 186.5. Here, and it's starting to show up. It's also the 23.6 of that move here. So of this move, okay, the start of 2024, 23.6 around here, I think. Yeah. So yeah, that's the level we'll look at. And then on the top side, 187.30 is still going to be around I reckon, for a bit of activity. If we get back above those higher 187s, then we're probably going for a retest of the highs, okay? But in the meantime, it does look like we're trying to form a bit of a top here. It's looking a little bit similar in most of those yen pairs, I must say, of late. I'm not a big fan of the yen for longer still. But I was saying in the room, if euro does not show too much better data, I may make an exception for the euro yen. That euro yen looks to me like we are starting to build solid tops there. But that's again, as I said, more for the medium term. Euro Aussie here, 163.5, 163.40, exactly where we stopped. See it? That's exactly where we stopped, and that's what I was saying. The euro crosses are showing some rebound this morning, so this is really levels that you're going to have to keep an eye on. Okay, this one here as a support. And top side, we may be in a little bit of resistance right here, really short term. But then I think much more important in the low 165s, 165, 165.15. Okay, that's for your euro Aussie. Euro Kiwi, I'm not really a big fan of trading these. I usually don't actually do much of euro Kiwi. It's very volatile. But as you can see, we have found the latest resistance in between the 100 and the 200 DMA for one. And the cloud is not really very representative. But yeah, we also see the same rebound as we see in all of the euro crosses. And look, we've also stalled on the 61.8. That's comparable to your euro Aussie, okay? Yeah, that's where we bounce from. So this is your level to the downside, and then here around those moving averages, and in the 177.25, perhaps first resistance for the euro Kiwi. Swiss, Brad, we've been talking so much about it in our rooms, mate. You should really go to our room and look everything that we're putting on the Swiss, because it's an ongoing conversation in the Swiss. But we were talking about this 86, the figure 86 figure 5 in dollar Swiss, mate, is where the support is clearly. Okay, this is where the support lies. All right, this is it. And with that, Mr. Ryan, back over to you.
Thank you very much, sir. I'm just going to grab it back ever so quickly, just to have a quick butcher's at what's coming up today. Lots of data this week, as you know. Lots of stuff coming through. Get some house price data from the US consumer confidence. That's the big conference board number, not the Michigan one. JOLTS as well. That's coming out. It's a bit lagging data, JOLTS, but it's all playing into the jobs picture today. And then a bit of Japanese data tonight. So particularly for the US session, keep an eye on all those numbers, see what moves are going to happen, the last minute jockeying ahead of the Fed. And on that note, thank you very much for coming to the Flow Show. Thank you very much for keeping Kay on his toes yesterday. And thank you, Kay, for covering. And we shall see you all tomorrow. Thank you very much.
Have a good day, folks.